If you have some experience and are serious about the stock market, you've probably seen Japanese candlesticks on your price charts before. Japanese candlestick charts are one of the most widely used charts in the stock market. And that is why in this video, I'll be going through with you how to read Japanese candlesticks and Japanese candlestick patterns. And I'll also be sharing with you some of the most powerful Japanese candlestick patterns. So if you are interested in all of that, stick around in this video. Before we start, I have a quick starter guide on Japanese candlestick patterns in my free Facebook group. If you want to have the guide to complement this video, I've placed the link down below in the description section, and you can get the guide by joining my free Facebook group. Alright, let's get started with the video. The two most commonly used charts are the candlestick charts and the bar charts. Candlestick charts looks like the one on the left of your screen, and bar charts looks like the one on the right of your screen. In this video, we'll be taking a closer look at the Japanese candlestick charts. There are 4 elements that make up a Japanese candlestick. The first is opening price, second is closing price, the third is the highest price, and the fourth is the lowest price. With these 4 information and elements, we are able to plot our candlestick, and vice versa. If we only have our candlestick instead, we are then able to reverse engineer and find out this 4 information. Let's take a look at how these 4 elements go into a candlestick. The first part of the candlestick is this rectangle, and this rectangle indicates the real body of the candlestick. The real body of a candlestick will indicate to us the opening and closing price for that candlestick. So we want to pay attention to the top part of the rectangular body and the bottom part of the rectangular body. At the top part of the body, we have the opening or closing price, depending on the nature of the candlestick. We either have a bullish nature candlestick or a bearish nature candlestick, and the nature of the candlestick will determine where the opening and closing prices for the candlestick are. The next one is at the lower part of the rectangular body. The lower part of the rectangular body also indicates either the opening or closing price of the candlestick. And similarly, it depends on the nature of the candlestick, whether it's the opening or closing price. After that, we have the upper wick or the upper shadow. And at the uppermost tip of the upper shadow, we have the highest price. Correspondingly, at the lowest tip of the lower shadow, we have the lowest price. So with this 4 information, the opening price, the closing price, the highest price, and the lowest price, we are able to plot our candlestick. But if we do not have this 4 information, but only with a candlestick, we are still able to find this 4 information by reverse engineering the candlestick. With just a candlestick, we know that the uppermost part of the upper tip is the highest price for the candlestick. And at the upper part of the rectangle, we know it's either the opening price or the closing price, depending on the nature of the candlestick. And similarly, at the lower part of the rectangle, we know that it's either the opening or closing price. And lastly, at the lowest part of the lower wick, we are able to find the lowest price. Now that we know the basics of a candlestick, let's take a look at the bullish and bearish candlestick. A bullish candlestick is typically indicated by its green body. And what a bullish candlestick tells us is that on that particular time frame, there were more buyers than sellers. And when there's more buyers than sellers, the closing price is higher than the opening price. With that said, the lower part of the real body or the rectangle will be the opening price, and the upper part of the real body will be the closing price, and the highest point of the upper wick will be the highest price. Correspondingly, the lowest part of the lower shadow will be the lowest price. And there you have it, the bullish candlestick. The important point to take note for a bullish candlestick is this: the closing price is higher than the opening price. So even without this 4 information, if we see a green body candlestick, we know that the candlestick is a bullish candlestick, and a bullish candlestick closing price is higher than its opening price. The next candlestick is the bearish candlestick. A bearish candlestick is usually indicated by a red body. And for a bearish candlestick, the upper part of its real body is indicated by its opening price, and the lower part of the real body is indicated by the closing price. Because a bearish candlestick indicates that for that time period, there were more sellers than buyers, prices fell during that period. It tells us that the opening price is higher than the closing price. And that is why for a bearish candlestick, the opening price is higher than the closing price. And for the upper wick, the uppermost part of the upper wick is the highest price. And the lowest part of the lower wick is the lowest price. So far, we have covered 2 candlesticks, the bullish candlestick and the bearish candlestick. And to recap, a bullish candlestick indicates to us that during that time frame, there were more buyers than sellers. And as a result, prices increased during that period. And when prices increase during that period, the closing price will be higher than the opening price. And that is why for a bullish candlestick, the opening price is lower than the closing price. And for a bearish candlestick, there were more sellers than buyers. And this pushes prices down. And that is why in a bearish candlestick, the opening price is higher than the closing price. The next candlestick that we'll take a look at is the Doji Candlestick. The Doji Candlestick is characterized by its small real body. So on the screen, you'll see that instead of a long rectangular body, we have a negligible real body as indicated by the small line. This indicates to us that the opening and closing price is at the same level or close to the same level. And we will have the upper wick and the lower wick. The highest point of the upper wick will be the highest price, and the lowest point of the lower wick will be the lowest price. Unlike the bullish and bearish candlesticks, for a doji candlestick, there's no clear winner. Buyers match the sellers and the sellers match the buyers. And that is why the opening price is at the same level as the closing price or close to the same price. Another thing to take note is this: a doji candlestick doesn't necessarily have to look exactly like this candlestick over here. It can also look like this candlestick over here. The important characteristics of a doji candlestick is that it has a small real body relative to its upper wick and lower wick. For this example, you see that this is a small real body relative to the upper wick and relative to the lower wick. And you'll see in the coming examples there are many variations to the doji candlestick. Let's take a look at the first variation of a doji candlestick. The shooting star being a doji candlestick has a small real body. And for the doji candlestick and its variation, the color of the body of the candlestick is not really important. And this is because the opening and closing price are very close to one another. So in this case, the opening and closing price doesn't really matter for the candlestick. However, what is important for the shooting star candlestick is that it must have a long upper wick or upper shadow, no or very short lower shadow. The highest price for this candlestick will be at the uppermost part of the upper shadow. These are the 4 things that you want to look out for in a shooting star candlestick. The first is that it must have a small real body relative to its upper shadow, and the upper shadow must be at least twice the height of the real body. The third thing is that the candlestick must have no or very short lower wick. We use the shooting star candlestick after an advance or a rally. We want to see prices rising for quite a while, and after the extended advance or rally, when a shooting star appears, it indicates to us a possible bearish reversal. What a bearish reversal means is that prices have a high probability of declining after that. So after prices have risen for quite a while and a shooting star candlestick appears, it indicates to us a bearish reversal signal. And this bearish reversal signals to us that prices might start to decline after that. So say we bought a stock and the stock advanced and rally, and after rallying and advancing for quite a while, and when a shooting star appears, we might want to cash in some of our profits first, or at the very least pay closer attention to our stock. The next candlestick is the inverted hammer candlestick. The inverted hammer candlestick looks exactly like the shooting star candlestick. Both have a small real body and a long upper wick. However, there's a difference between the inverted hammer candlestick and the shooting star candlestick. And the difference is that the inverted hammer candlestick appears after a decline, while the shooting star candlestick appears after an advance. So after prices decline for quite a while and an inverted hammer candlestick appears, this indicates to us a possible bullish reversal signal. And what a bullish reversal signal indicates to us is that prices have a high probability of advancing after that. What this means for us as investors and traders in the stock market is after an extended downtrend and an inverted hammer candlestick appears, this can provide us a signal to start looking for opportunities to buy. So while the shooting star candlestick and the inverted hammer candlestick looks exactly alike, they indicate to us 2 different things. For a shooting star candlestick, we want to see a shooting star candlestick appear after an extended rally. And this shooting star candlestick indicates to us a possible bearish reversal. On the other hand, we want to see an inverted hammer appearing after an extended price decline. And when the inverted hammer candlestick appears after an extended price decline, this signals to us a possible bullish reversal and that prices might start advancing from there. The next candlestick is the hanging man candlestick. The hanging man candlestick also has a small real body. And similar to other doji candlesticks, the color of the real body is not that important. So the opening and closing price is interchangeable. However, what is important is the long lower shadow. For a hanging man candlestick, we want to see the candlestick having a long lower shadow or long lower wick, and no or very short upper shadow. The lowest price for the candlestick will be at the lowest tip of the lower shadow. And we want to see these 4 things in a hanging man candlestick. A small real body accompanied by a long lower shadow. And the long lower shadow should be at least twice the height of the real body. And on top of that, we want to see no or very short upper shadow. And lastly, we want to see the hanging man candlestick forming after an advance or a rally. After prices have advanced and rallied for quite a while, and a hanging man candlestick forms, this indicates to us a possible bearish reversal signal. And what a bearish reversal signal tells us is that there is a high probability that prices are likely to decline after that. So if we bought a stock and the stock has advanced for quite a while, and suddenly a hanging man candlestick forms, we want to take some of our profits off the table, or at the very least pay closer attention to our stock. The next candlestick is the hammer candlestick. The hammer candlestick looks exactly like the hanging man candlestick. Both have a small real body, long lower shadow, and no or very short upper shadow. However, the difference between a hanging man candlestick and a hammer candlestick is where they appear at. For a hanging man candlestick, we want to see the candlestick appearing after an extended rally or advance. But for the hammer candlestick, we want to see the hammer candlestick forming after an extended decline. So when prices have declined for a bit and the hammer candlestick forms, this indicates to us a possible bullish reversal signal. This means that prices have a higher probability of rising after that. And that is also another difference between the hanging man candlestick and the hammer candlestick. A hanging man candlestick indicates a bearish reversal signal, while a hammer candlestick indicates to us a bullish reversal signal. Next, we'll take a look at some 2 candlestick patterns. The first is the bullish engulfing pattern. For a bullish engulfing pattern, we want to see 2 candlesticks. The first candlestick must be a bearish candlestick and the second candlestick must be a bullish candlestick. The body of the bullish candlestick or the second candlestick must be larger than the body of the bearish candlestick. As mentioned earlier, these are some of the characteristics of a bullish engulfing pattern. The first candlestick has to be a bearish candlestick followed by a bullish candlestick. And the body of the second candle, which is the bullish candlestick, must engulf the first candlestick body. And lastly, ideally, we want to see a bullish engulfing pattern forming in a downtrend, or when prices have declined for quite a while. When prices have declined for a while and a bullish engulfing pattern appears, this signals to us a possible bullish reversal signal. And just like the other bullish reversal signals, a bullish engulfing pattern indicates a higher probability that prices will rise after that. So if you are looking to buy a stock, buying a stock after a bullish engulfing pattern has appeared will give you a higher probability of success. The opposite of a bullish engulfing pattern is the bearish engulfing pattern. Similar to the bullish engulfing pattern, the bearish engulfing pattern has two candlesticks. But unlike the bullish engulfing pattern, the first candlestick in a bearish engulfing pattern is a bullish candlestick and the second candlestick is a bearish candlestick. And the body of the bearish candlestick must be larger than the body of the bullish candlestick. So the first candlestick has to be bullish and then the second candlestick has to be a bearish candlestick. And the body of the bearish candlestick must engulf the body of the bullish candlestick. And ideally, we want to see the bearish engulfing pattern appearing after prices have advanced for quite a while. When prices have advanced for quite a while and a bearish engulfing pattern appears, this signals to us a possible bearish reversal. And a bearish reversal indicates to us that there is a high probability that prices are likely to decline after that. So when a bearish engulfing pattern appears and we are still holding a stock, we want to pay more attention to the stock because there's a high chance that the stock might decline after that. The next two candlestick pattern is the piercing pattern. And for the piercing pattern, the first candlestick is a bearish candlestick followed by a bullish candlestick. And ideally, we want to see the opening price of the second candlestick, which is the bullish candlestick, opening below the closing price of the first candlestick. The next thing we want to look out for is that the closing price of the second candlestick, which is the bullish candlestick, closing well within the body of the first candlestick. These are some of the characteristics we want to see in a piercing pattern. The bullish candlestick opens lower, ideally under the low of the bearish candlestick. And the next thing that we want to see is that the bullish candle body closes more than halfway into the bearish candlestick body. And ideally, we want to see the piercing pattern forming in a falling market. In a falling market, when a piercing pattern appears, this indicates to us a possible bullish reversal. And the bullish reversal tells us that prices have a high probability of rising after that. The next two candlestick pattern is the dark cloud cover. The first candlestick is a bullish candlestick followed by a bearish candlestick. And we want to see the opening price for the bearish candlestick at a higher level than the closing price for the bullish candlestick. And the second thing that we want to look out for is that the closing price for the bearish candlestick over here closes well within the body of the bullish candlestick. These are the characteristics for a dark cloud cover pattern. Ideally, we want to see the bearish candle body closes more than halfway into the bullish body. And we want to see this pattern forming in a rising market. In a rising market, when a dark cloud cover pattern forms, this indicates to us a possible bearish reversal signal. And the bearish reversal signal tells us that there's a high chance that prices are likely to decline after. The next candlestick pattern is a 3 candlestick pattern. And we call this pattern the morning star. For the morning star pattern, the first candlestick is a bearish candlestick, followed by a doji candlestick, and lastly a bullish candlestick. And there must be a gap between the bodies of the bearish candlestick and the doji candlestick, and also a gap between the body of the bullish candlestick and the doji candlestick. These are the things that we want to look out for in a morning star pattern. And we want to see a morning star pattern forming in a falling market. So in a falling market, when prices have declined for quite a while, and a morning star pattern forms, this signals to us a possible bullish reversal. And by now, you're probably an expert in bullish reversals and bearish reversals. So the bullish reversal signal by the morning star pattern indicates that there's a high probability that prices will rise after that. The opposite of a morning star pattern is the evening star pattern. And for the evening star pattern, we want to see a bullish candlestick first, followed by a doji candlestick, and then a bearish candlestick. We also want to see a gap between the body of the bullish candlestick and the doji candlestick, and a gap between the body of the doji candlestick and the bearish candlestick. This is what you want to look out for in an evening star pattern. And we want to see an evening star pattern forming in a rising market. In a rising market, after prices have risen for quite a while, and an evening star pattern forms, this indicates to us a possible bearish reversal. And like the other bearish reversal signals, this indicates that there's a high probability that prices are likely to decline after that. In this video, we have gone through on how to read Japanese candlesticks and Japanese candlestick patterns, and I also share with you some of the most powerful Japanese candlestick patterns. So if you have liked and learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel, don't forget to subscribe because you don't want to miss out on future videos such as this on investing, trading, and the stock market. I'll see you in those other videos to your financial success.